by refinancing the property, say the same example, you bought the property for $500,000. It's now worth $1 million. You could go to the bank and ask them to refinance the property and pull out the $500,000 of equity that you've generated.
Hello, and welcome back to the Very Real Estate Effect podcast, a show dedicated to real estate investing. Today is part 2 of my friend Matt Lipman here from Mogul CPA. Hey, Matt, how are you doing?
I'm doing great. How are you, Axel?
Super. So for those who didn't listen to the first episode, rewind 1 week and go back, listen to this one first, because Matt shares all about him and where he got where he's at today, his experience, his background. And today's episode is going to be more focused on real estate. The previous one was more of an accounting one with great tips about some of the things that you can do to improve your operation for your real estate accounting. So Matt, what would be, you've worked with many clients in real estate, and what do you see as some of the most successful strategies right now?
Well, I think to get started in real estate, and I think really to get started in any business, the first thing to do is that you need to set your expectations, right? I think that we're currently living in a world with Instagram and TikTok, and everybody's telling you that you can make millions of dollars in just 2 or 3 months, or even overnight. And, as an accountant, I've had many young guys and young women come into my office with maybe a partner, and they have this amazing idea and plan to get it all set up, and they're expecting, when I ask them what their expected annual revenues are, which is a question that you need to submit to the government, they tell me 100 or 200 or even sometimes up to $1 million in their first year. And
those are bold projections.
Yeah, in my experience, I've yet to see one of those actually make it to that level so quickly. So in any business, I think delayed gratification or setting your expectations is super important. And you should, at a minimum, especially in real estate, give yourself 5 to 10 years before you have any expectation of making any amount of money. Mm-hmm. So that's the first thing that I would say.
So one, proper expectations.
Yes, definitely. Now, the second most important part of developing a really important real estate strategy is delayed gratification. It's also not a technical tax topic, but I think it's something that needs to be discussed, right? Yeah. Delayed gratification, meaning that you want to sacrifice as much upfront for the long-term growth of your business, right? So if you're in your 20s, you're just starting your career, I know you're probably not making that much money right now, but you still need to save. The earlier you could get into the business, the better it is long term. Yeah. The earlier you get into the business, the sooner you will reap the rewards. So I think it's super important to delay gratification. I know you probably want to go out with your friends every night and spend that money that you got from that you're earning from your first couple years in your career. But if you want to be successful in real estate, I think one of the biggest things is cutting those expenses out, saving, and finding a way to get your hands on a property as soon as possible. Yeah. Mm-hmm.
And in the getting your hands on a property as soon as possible, the house hack of like buying a duplex or triplex, living in one, and then managing 1 or 2 tenants is a fabulous way to start.
Oh my God, yeah, that's the best way to start. I think, yeah, totally the best way to start. You want to. I think that from a financing point of view, house hacking is great because you could put 5% down. Mm-hmm. You don't need to come up with that 20% deposit that is required for, rental units.
Yeah.
You could put 5% down and then rent out the rooms in that house to other tenants, and that's an extremely good way to build equity in your property really quickly.
Yeah.
Mhm.
And so for those who aren't aware, we'll just rewind a little bit. So what Matt is talking about here is that if you house hack, so that's when you live in the building or you live in the apartment and you rent out 1 bedroom, 2 bedrooms to somebody else. Let's say you buy a triplex, okay, and you're in the Montreal area. You buy a triplex for, let's say, 600,000. If you go through CMHC as an owner occupant, you can put just 5% down. So what's 5% of 600? That's 30,000.
Mhm.
30,000. If you are working, you're with your spouse, you're with your brother, you should be able to put together $30,000. Now that's just going to be the down payment. You also need some of your closing costs. So you'll probably need still, 50 because you're going to get the welcome tax. You need to go to the notary. You're going to have a little bit of due diligence and so on. So it is realistic to start when you're fairly young. I'm thinking of younger Matt when he was in his earlier days as a junior accountant to save money and go and buy a triplex because that's going to appreciate over time. You get to live in one of the units, you rent out the two others. 10 years later, you're so happy you made this choice.
Absolutely. I think, Dave Ramsey had a quote. I think it's something like, what's the fastest way to save $5,000? And it's save $5 a day
Yeah,
for a year,
basically. Mm-hmm.
So it's, $50,000 is definitely something that's super tangible. If you're serious about your financial future, make yourself a budget. Cut out as many expenses as possible. You still need to live your life, of course, but you want to reduce those expenses as much as possible and take those savings and put them into a property as soon as possible.
Yeah.
Mm-hmm.
So in getting started, like some of the two main strategies, some people look at it as either go for cash flow or go for equity. You, from an accounting point of view, it's not a question of which one works best. I guess it's just different and it's tailored to people's preferences.
Yeah, well, actually, I think that, let's expand. Let's dig into that point a little bit more. I think that there's two main strategies of investing in real estate, right? You could either go for the appreciation of a property, and usually the properties that appreciate the fastest are the ones that are in, the AAA neighborhoods. And unfortunately, those ones can't command as high of a rent relative to the price of the property.
Yeah.
So a lot of the times for those AAA neighborhoods, those properties that you're looking for an appreciation, you won't be doing so well on cash flow. You may even be netting negative cash flow month in, month out, right? So that's a really long-term play because you're just betting on the appreciation of the property. Now, I think that strategy is particularly good for somebody that wants to build a real estate portfolio, but that also has a side gig, right? Because of course, if you're netting negative cash flow every month, you're not going to be able to be putting food on the table for your kids, right?
No, that doesn't pay the bills.
Yeah, and that's not good. Nobody wants that.
No.
So, but on the other hand, if you have another cash cow or cash generator that you could lean on while you're waiting for the properties to appreciate, this is an extremely good strategy because actually all of those negative cash influxes or outflows could be deducted against your personal income that you're earning from your other side business. So whether you're a doctor, you're a lawyer, whatever, maybe an IT guy, you could actually reduce your taxable income using these losses that you're generating from real estate and get a nice check from the government back at the end of the year, which is great.
Well, and that's why it's such an appealing asset class to a lot of high income earners, is because they're able to write off a lot of the expenses.
Yes, exactly. Now, if you want to look at the other strategy, which is more cash flow, which is taking a more cash flow focused approach, usually you're going to be dealing with not AAA neighborhoods,
Yeah.
right? So maybe a B class neighborhood. Um, but those properties generally command higher rents in comparison to the value or the cost of the actual property. So this is a good methodology or a good strategy if you are going into the business with the intention of making it your thing.
Mhm.
If you want to be like a full-time real estate guy, then for sure generating a portfolio that generates cash flows is an amazing way to go, right?
Yeah.
Now, the thing about that is that you will be taxed on the net cash inflows that you're receiving, right? So there is an element. So you're not going to be able to, you'll actually be paying taxes on the income that you're generating
Yeah.
from the real estate
And that
portfolio.
income will just be added to your income tax, to your income.
Yeah, exactly. Yeah, exactly.
Mhm.
Now, I think from a tax point of view, it's super important to discuss, you know, what happens when a property appreciates in value. What is the tax consequences that arise from a property appreciating in value? So, if you sell the property, then you're going to have a capital gain.
Yeah. Knowing
Uh,
that it's your personal resident, your primary residence.
oh, if it's not, I'm talking about if it's a primary residence,
Mhm.
then you don't have to worry all of that.
Yeah.
You don't pay taxes
You're
on the
exempt.
sale of a primary residence,
Okay.
right? But for an income property, when you sell it,
Mhm.
there's actually a capital gain.
Yeah.
So you have to pay. It's taxable at 50%. So say you bought a property for $500,000 and then you sell it for $1 million, you have a $500,000 gain.
Mhm.
But because it's considered a capital gain, only half of it is taxable. So you only pay taxes on $250,000 of income,
Mhm.
right? Which is generally something that I don't recommend. Like from a tax point of view, it's better not to sell your property because you could actually refinance the property, right? So by refinancing the property, say the same example, you bought the property for 500,000. It's now worth $1 million. You could go to the bank and ask them to refinance the property and pull out the $500,000 of equity that you've generated. So in this case, you're basically getting the same proceeds of cash from the bank, but you're not triggering a capital gain. So you actually have no income taxes to pay on that cash withdrawal from the property.
Mhm.
And you could easily take that cash out and buy another property, right? You could actually probably buy,
Two.
two, an extra property than if you were to have sold the building,
Yeah. Mhm.
So this is the way that real estate investors really build wealth, right? It's by hanging on to what they have. I think it's really important to have a strategy going in, whether you're going to be going for a cash flow strategy or if you're going to be going for an appreciation strategy, and know, you have to consider in your timeline how many properties you will be buying, what your strategy is going to look like long term, but definitely try to not sell your properties.
Yeah.
It's not that's not the way that real estate investors build wealth.
Mhm.
Mhm.
No, and as you said, like the ability to refinance is a fabulous way to tap some of that growth, and to turbocharge the rest of the portfolio by being able to buy more. So you just pull out some of the equity in your existing properties to go and fund the next one. And so with the CMHC, you can go back to loan to value of 85%.
Mhm.
I like to say you squeeze everything out and then you take some of that equity and you go buy the next building.
Yeah, exactly. And on a long-term basis, right, the rents will catch up to the
Mhm.
cost of the property. So your debt servicing obligation will come down
Yeah.
and your rents will increase to the point that you will be generating cash flow, even if you're taking a more of an appreciation strategy, an appreciation focused strategy to your business.
Yeah.
So I think that if you can afford it, the appreciation focused strategy is the way to go.
Mhm.
But the best real estate strategy is the one that you could afford. That's first.
Yeah. And it goes back to what you said earlier of like having a proper expectation, and then starting as early as possible, as young as possible, so you can let it compound and appreciate over time.
Definitely,
Mm.
definitely.
Before we started, we also talked about now there's a lot of investors that are kind of moving from optimizations to new constructions.
Hmm.
Now, new construction is a whole other can of worms when it comes to accounting, to financing. And you mentioned that there's some ways in which we can claim back the taxes.
Yes. So actually, I have a funny story to tell related
Please.
to this. So I had a client that was looking to purchase a property, a country property,
Mhm.
right? Something up north by the lake that he could enjoy with his family, but also he wanted to generate some revenues from the property, right? Which is not an uncommon thing. A lot of people are looking for this. So, he actually had conversations with a real estate developer that was developing a piece of land up north. And he ended up going into contract for one of the properties after the real estate developer agreed to make some accommodations to the property to make it suitable for a bed and breakfast style business,
Mhm.
but also wonderful for your family and kids to enjoy, right?
That was just more bedrooms?
Whatever the layout, there was I think an ensuite, a
Okay.
small ensuite for every bedroom, and the layout
Mhm.
was more accommodating to host different
Okay.
people at different times. Um, so with all new constructions, there is an obligation for the seller to charge GST and QST
Yeah.
on these properties, right?
Mhm.
So in this particular case, I think that he was selling the property for 500,000 plus GST and QST, which is significant
Yeah.
cost, right?
Yeah.
We're talking about 75 grand on top of the 500, right?
Mhm.
And my client came to me and he asked me, like, Matt, is there any way that we could get this money back, right? I think for a lot of business owners and entrepreneurs that are investing in residential property, if you're charging rent, like just rent on residential property, you cannot include taxes.
No.
It's not a
No.
taxable
No.
thing, right? Um, but in this case, I suggested to him that he look to list the property on Airbnb.
Mhm.
And now with the new laws that Airbnb is subject to, all of the people that are renting on Airbnb are actually obliged to register for GST and QST. So it's because um, it's viewed under the law as more of a hotel stay
Yeah.
rather than a residential rent.
Yeah. Yeah.
Okay.
Yeah.
So that's exactly what we did. We opened a company for him. We registered the company for GST, QST. He bought the property through the company. Immediately after he bought the property through the company, we filed for a rebate of $75,000. He received a check of $75,000 in the mail, and he's currently renting out the property on Airbnb and doing extremely well.
So he was able to get the entire tax back right off the bat?
The entire tax back right off the bat, yeah. Whereas everybody else in that development eat that tax cost,
Yeah. Because
Pretty
they
incredible.
purchased in their own name.
They purchased in their own name. They didn't register for GST, and that's what most people do with new constructions, right? And even if they are renting it out, maybe they'll do a long-term rental, and it's not taxable.
It's not taxable.
But it's very key in this strategy to look at it with your accountant before, because you need to make sure that you register for the GST prior to the to going into contract for the property, or even pre-construction for the property, right? Yeah.
And hence why it's important to work with a good accountant and plan ahead.
And I'll add that in this particular case, because the property was, I think, 2 hours away from the city, or from his main primary residence, he needed to purchase a truck to go back and forth between the property and his home, and to also carry out whatever regular repairs and maintenance the property required. And because he was registered for GST, QST, he was actually able to claim back all the GST and QST that he paid on the truck, which resulted in another, I think $7,000 or $8,000 in tax savings right then and there, which is incredible. Over $80,000 in tax savings on this one specific transaction. Mhm.
And that then triggers the question that most accountants get very often from real estate investors is, should I incorporate or not? And I'm sure you,
Yeah.
in a way, you must get tired of that question because I guess the answer is always, well, it depends on your situation. And I think I did ask this question before on the podcast to somebody else, and I'd love to hear your take on it. Like, what do you answer to that?
Um, I think I have to give the generic answer that it does depend.
That's the thing. So what does it depend on?
It does depend, but I think a lot of accountants out there will kind of more steer you towards incorporation,
Mm-hmm.
just because that in itself generates more fees for them, and it also makes it cleaner for the accountant to have a separate entity that holds all of the property that is owned by a specific client. And that is a legitimate argument, right? But
Sure.
I think my point of view is that it's my job to clean up these messes and to simplify everything for my client. That's what we do. And I think going back to this, which strategy you're focused on, I think that if you're really focused on a cash flowing strategy, then it's certainly better to put the property in a incorporation. It's because the corporation will pay its own taxes on that. There won't be any excess taxes from an overall point of view, but the corporation will pay its own taxes on that. It'll house all of the properties, and you'll still be able to get a small business deduction, long term if you have over 5 employees. That's the test for the small business deduction. Whereas if you if you're going for a more appreciation focused strategy, then it's probably better to own the properties personally, because this way you could write off all the losses that those properties are generating on a recurring basis against your own income. So I think it's definitely something that needs to be looked at by an accountant. You need to have discussions with your accountant. There's more fees associated with incorporation usually than with holding the properties personally. And I'm not a lawyer. I do recommend always like getting an opinion from a lawyer, because corporation definitely has some implications with limited liability as well.
Yeah, that's a very good point. And sometimes I know I've been frustrated by well, it depends on your situation type of answer. My wife is a tax lawyer and she always puts it very well. I was like, if you're going to go with an appreciation strategy, it totally does make sense to take the first 2-3 properties in your own name, given they're not like 24 units a pop, of course, because then there's also a scale factor. But let's say you buy a triplex, a sixplex or something like that, take it in your own name. I mean, you're going to be adding a little bit of income to your work income, but not that much. And at the end of the day, the tax code is made so that whichever way you do it, in the end, you kind of have the same take home. So you're going to get taxed the same way, whether it goes through a company and then the company is taxed and then you either pay yourself a dividend or you're an employee or what. At the end of the day, the tax man gets his fair share.
Oh yeah. Yeah. That's for certain. I think you really need to take the time to think about what you want out of the business and iron out, at least a 5 to 10 year plan. And that a lot of those decisions should be based off those 5 to 10 year plan, like what your intention is to do in the next 5 to 10 years, right? And that it should be noted that, it is possible to move the property into a corporation later on when it's time. It's a bit of it's really not a complicated transaction. A lot of people make it seem more complicated than it is, called Section 85 rollover. And it's entirely possible to move the property into a company when you need to.
And does that mean that you need to pay the welcome tax again, or how does it work?
No, you're actually exempt from you should be. You have to check with I think it's a municipal. It depends on which municipality maybe, but I believe that there's normally an exemption since you're moving it into a related entity.
A related entity that you own as well.
That you own, yeah, exactly. Yeah.
So then they can really see that it's not to avoid taxes, it's just because you're changing the ownership structure and you've already
Exactly.
paid it once and stuff. So does that mean that could we kind of, I don't want to say disguise a sale, but let's say I owned a sixplex and after 3 to 5 years, I roll it into a company in which you have an ownership as well. And
Mm.
then after a few years, I sell you my shares. Would that be a way to,
Listen, I think that there's a lot of strategies out there of people trying to avoid welcome tax,
Mhm.
and that the government is aware of them
Yeah.
for sure, you know, and that each situation is particular. I think it depends on the municipality, it
Mhm.
depends on the nature of the transaction, and really, you should have it looked at by a lawyer.
Yeah.
But generally speaking, if you're trying to transfer ownership through some complex transaction that is being used to avoid welcome tax, it's probably not going to work.
It's probably not going to work. Exactly.
Yeah.
They've seen it all. You can try to be as creative as you want.
Oh yeah,
You're not going to
exactly.
come up with anything that
Yeah.
they haven't seen or dodged before.
Yeah. Yeah. Listen, I mean, everybody has their own strategy. Some people try and fly under the radar with whatever tax strategy, but you want to be above board with everything.
Yeah. And again, I have no problem with paying taxes. I have 2 young kids who go to school. I'm very they go to public school. I'm very happy to pay for kids' education through taxes. It's just that I just want everybody to pay their fair share, and I'll pay my fair share. Now, when it comes also to taxes, like if you just have 1 or 2 pieces of real estate in your own name, you're able to, as we said, like write off some of those expenses.
Mm-hmm.
So for high income earners, it's a great way to reduce their taxable income.
Totally. Yeah, definitely.
Do you work with a lot of clients who are in this situation and who actually seek out and buy real estate specifically for that purpose?
Well, that's actually a more substantiated strategy in the US
Mm-hmm.
because you could bonus depreciate assets in the US.
Mm-hmm.
So in the US, it's actually possible to almost expense the entire cost of a property in year one.
Yeah, I heard about that for Airbnbs. I just
Yeah.
couldn't believe it.
It's crazy. Right?
Yeah.
Yeah, it's actually and it's an interesting tax policy that the US has, and
Mm-hmm.
a lot of people, it's not only houses, people will actually go and buy private jets like on December 31st. Grant Cardone loves to talk about how he's bought his private jet on the last day of the year and wrote all of it off against his taxes. But in Canada, it's not quite as easy. I think for an effective real estate strategy in Canada, you really want to be looking at, you don't want to be looking at an asset that's generating losses. It can be generating losses on their profit and loss after every year if you're getting the appreciation out of it, right?
Yeah.
If the value of the property is appreciating, then it doesn't really matter if the rents are higher than the operating expenses.
Yeah, and some years you might have had some big repairs to do. It totally makes sense. It's just you can't have a loss every year.
Totally. But you can, sometimes you can have a loss every year. If you buy like a heritage property, it costs a fortune to maintain these properties, but they increase in value like crazy. If you're getting 20% gains on the value of the property year in, year out,
Mm-hmm.
doesn't really matter if you're netting, $5,000 or $10,000 in the red on a year-to-year basis. Is you're getting that. At the end of the day, 5 years after you buy the property, you'll be able to refinance it or sell it and make up for all of those red years.
Yeah. It does make sense. And then just kind of before we start to conclude, when it comes to, would you have some advice as to how to avoid audits? And I guess it's just like, well, be clean, don't do anything bad, and usually that's that helps. But have there been patterns with people who have gone audited, and what would you give as advice to avoid it?
File on time.
Yeah, that'd be a great one.
I mean, I like to think of it as if I was an auditor, even though I would never, but if I was an auditor working
Thanks for the disclosure. I would never.
If I was an auditor working for Revenue Quebec, then and I saw that somebody was filing their tax return or their GST returns late, like year in and year out.
Yeah.
I would know that this guy that probably doesn't have his stuff together. Right? I know that his accounting is probably a mess, and he's an easy kill for
Yeah.
me as a predator,
Yeah.
right? So I think definitely filing on time. I like to, if ever there's, if ever because sometimes they'll do what's called desk audits, where they'll send a letter being like, say your professional fees are for 2023 are extremely high. Send me a copy of the 10 largest invoices that make up the professional fees that you've included on your tax return. I like to send that as soon as possible.
Yeah.
You know, like I don't want to, they'll give you like 3 months before the deadline, but if you send it to them
Yeah. Within 3 days.
within 3 days, like
Yeah.
they know that
Yeah. You're organized.
you're
You're
organized,
sharp.
you know what's going on,
Fair.
right?
Yeah.
Another thing that will definitely trigger audits quite often is GST refunds. If you're claiming GST refunds all the time, if you're entitled to them, that's entirely fine.
Yeah.
But make sure when you claim a GST or QST refund that you have all of the receipts to back up all of those GST and QST credits. Because a lot of the time, if you claim a refund, you're getting audited right away. You know.
Yeah.
And yeah, I think those are the main points.
All right. So for everyone out there, remember, in the end, just be organized. That's really what it comes down to.
Pretty much, yeah. I think you need to have a competent professional that takes care of your accounting. Certainly, once your business reaches a certain size, you want to make sure your standard operating procedures are in place so that all of your expenses are being deducted. There's a backup for every expense. The accounts receivables are being done properly. All of the reconciliations are being done. All of that stuff that entrepreneurs do not want to look at.
Yeah.
You should outsource it.
A very good advice. Matt, it's been a pleasure to have you on today and to have this conversation. Tax is always a topic tax and accounting is an area of what we do that always generates a lot of questions. So I know it's been helpful to those who are listening. And if they have any questions, what's the best way to get in touch with you?
Yeah, please, if you have any questions, reach out. You could get in touch with me, book a free call on my website, mogulcpa.com. That's MOGUL There's plenty of links on the website that you could use to book a free consultation with me, and looking forward to helping you in any way that I can.
And if you know someone who could get some help, who's been struggling with it, please refer Matt, send it to a friend, just like this episode. Send me some questions if you have any. I'm in the process of booking my next episodes, and I will go and get some professionals to answer some of your questions. Leave me a review, send us some feedback, and of course, leave 5 stars on wherever you listen to this podcast. Thank you very much. As usual, keep researching your market, make some offers, and you'll go far. Take the appreciation strategy. I think it's the best one. But hey, all right. Thank you very much. Talk to you next week. Ciao.
Thanks, Axel.
Thanks, Matt.
Bye, guys.